Chairman.
Senator Bennet.
Thank you, Mr. Chairman. Mr. Secretary, it's good to see you. Thank you for your efforts here. Over the last 5 months or 6 months or whatever it's been, what I've discovered is that with respect to the federal intervention in the immediate crisis, I think it's fair to say there's very little consensus about the details of that or about it as a whole. And I know that it presents a huge struggle for you and for the administration because everybody's a critic, but not everybody has to come up with a solution. And I think you've worked hard to try to get through a lot of this. I think there's also limited consensus still about what we ought to do to fix the problem we've got prospectively. What people have come to understand is that we've come out of a decade where our savings rate as consumers dropped to zero. The federal debt ballooned from $5 trillion to $10 trillion. And banks or financial institutions on Wall Street that historically had been levered at 12 times were levered at 25 and 30 times. All of which, as you said in your testimony at the beginning, when it all came crashing down, have left our families in an unbelievably vulnerable position. Jobs lost, houses lost, college educations deferred for people all over my state and all over the country. And I know that we're designing this prospectively, but for the folks watching this at home, if we could rewind the movie that we just had play out of a period of an absurd amount of leverage in our economy, of risky decisions that should never have been made by people that should have known better, of risks that were taken actually in plain sight, but we missed it, all of us, in part because of the way our regulatory system was designed. As you rewind that movie in your head, looking back, let's imagine that the regime that's being proposed was in place, and how would things have been different as a result of that?
If what we're proposing today had been in place, banks would not have taken on so much risk. Institutions that were not regulated banks would not have been permitted to take on that level of risk. Consumers would have been less vulnerable to the kind of predation we saw, particularly in mortgage products. And the government would have had the ability to act earlier, more swiftly, to contain the damage posed by the inevitable pressures that come when firms fail. You know, again, we want a system where innovation can happen, when firms can fail, where investors are accountable for the risks they take in some sense, but you have to create a system that's strong enough to allow that to happen. So that's a simple way to say it. Banks would not have been able to take on this much risk. You wouldn't see this much risk build up, leverage build up outside the banking system to a point where it threatened the stability of the system, and consumers would have been less vulnerable to the kind of predation we saw, and the government would have been able to act sooner.
Who in the sort of the combination of the council versus the Fed versus the Consumer Protection Agency and all of this, who would have detected that we've got these things out here called credit default swaps that are mounting on the balance sheets of our banks, and that is a cause for concern, and to whom would they have communicated that, and what action would have been taken as a result?
Well, they were a bit of an orphan in the current structure, but under this regime, we're giving the SEC and the CFTC much more explicit authority. We're pushing the standardized piece of those products onto central clearinghouses, onto exchanges, and transparent electronic trading platforms, and giving the SEC better authority to deal with potential manipulation, fraud in those areas. That would have helped. If they were behind the curve, failed to act in that context, then the council would have the ability and the authority to bring that to light and to urge them to fix that problem. So I believe under this model, you're going to have the Secretary of the Treasury doing something I don't believe you ever asked the Secretary of the Treasury to do, which is to come before the Congress on a regular basis and report on evolution of risk in the system and whether the overall system as a whole is doing an adequate job of responding to those risks. Now, we won't have the full authority that Congress has given to the underlying regulatory agency. They will each have a piece of responsibility for that. But in some sense, you'll be able to look to the executive branch to say, is the whole thing work? Mm-hmm. Are we dealing with gaps? Are we adapting to emerging risks? And I think that will be a substantial improvement.
And then, Mr. Chairman, just one more question. And then, if all of that left us in the position where an institution that was a bank holding company found itself in crisis, we then have a new approach to resolution authority as well that you're proposing.
We would have a capacity to act earlier, I think more effectively, possibly at less cost to the taxpayer to contain the damage to the economy from that kind of specific challenge.
Thank you, Mr. Secretary. Thank you, Mr. Chairman.
Senator Corker.
Mr. Chairman, Mr.